Hey guys, Mr. O here, gonna give you a chance to kind of go over some stuff that might be on the test before the test. This is always a good opportunity to kind of make sure you're on the right track, studying the right things, your focus is in the right place, those types of things. And I'm hoping to just overall kind of help you out and improve your grade. So this is chapter 8. The test is over the investing lesson that we've talked about. One of the things that I want to start with is differentiating savings and investing, and just kind of knowing the difference. That will help you going through. So savings is anything that's less than 5 years, and investing is anything more than 5 years. And why that's important is because where we put our money matters. If we're going to use it between now and 5 years from now, we're going to want to put it in a different place than if we don't need it for longer than 5 years. So less than 5 years, this is stuff that we're going to put, this is maybe an emergency fund or something like that, and the location is going to be a money market, most likely. Doesn't have to be. I mean, if you're saving money, that's better than not saving money. But a money market has some advantages in that it does protect you from losses. Your money's not going to go down. If you put $1,000 into a money market, a year from now or 5 years from now, there's going to be at least $1,000 in there. It's not going to go down. So if we need money within 5 years, we sure don't want to lose it. So that's why we choose a money market. But a money market is also something that does pay an interest rate. It's not a very big interest rate. I think at the current time I'm recording this, the money market I have is like 0.75%, so just under 1%. That's better than 0%. You don't have to be very good at math to figure that out. And so if I have my emergency fund getting 0.75, I'll take that. It's better than 0. My emergency fund is not supposed to be growing. It's not the reason it's there. The reason it's there is for emergencies. So the time really has to do with our placement of money. Now, if we go back over here to our investing, this is when we start talking about 401ks and our Roth IRAs and our 529s, which is like a college saving type of thing. And of course, in most of these, we are investing in a mixture of mutual funds and perhaps some other things, but most of these have mutual funds in them, and most of us are not going to be retiring anytime soon. It's going to be more than 5 years. So we have a chance to gain more interest. That's why we would put it here. There is a little bit more risk, but since we have so much time, we do have an opportunity to gain more interest by taking that risk. So let's kind of go back over this for just a second, because it's really important to know why we're defining this as less and more than 5 years. It's really the placement and where we want to put it. If we're not going to use it for a while, we put our money into these types of things. If we're going to need it pretty soon, we put it into a money market. So that's important. And then just one last thing I wanted to mention, another term is liquidity, and how liquid or easy it is to get our money. If we have an emergency fund, we need it to be more liquid, and so a money market is more liquid. 401ks, Roth IRAs, those types of things are a little bit less liquid, so that's important to know too. We did talk a little bit about bonds in this lesson, and bonds, one of the examples we gave was a war bond, in which the government is going to issue bonds, people will buy bonds, and after a time their bond will increase in value and they can cash it in later. But in the meantime, the money that the government collected could be used during wartime. This has not happened in a long time. The last time we had a war bond issued was World War II. And so you should know a little bit about bonds and war bonds. We talked about that, but it hasn't happened in a long time. I want to mention mutual funds, because that's kind of one of the main focuses of our investing lesson. Mutual fund, it's well diversified. We know that with the total stock market as our example. It's spread over thousands of different companies. So the diversification is very nice with a mutual fund versus, say, a single stock. We also, can spread it out even more when we started talking about small cap and large cap and mid cap and even international. So, we have a lot of power to kind of control how we spread it out. And that's really one of the attractive features of mutual funds. If we were to look at a single fund like Apple or Microsoft or something like that, we're not spread out. Sure, we could buy a bunch of them to get us spread out, but it's definitely more difficult than just buying one mutual fund that already has that diversifications. Another advantage that we should probably talk about as we're talking about this is, and I guess maybe we've already been talking about it, but another way to put it is that these have less risk. These are more risky, the singles. And that's, for all the reasons we just talked about. If Apple, I do own Apple in a total stock market fund, and if Apple goes down in my mutual fund, I've got thousands of other companies to kind of keep me afloat. If Apple goes down over here by itself, there's nothing else left. One of the things I want you to remember, I think people kind of get scared that, they don't have enough money to invest. You can invest with small amounts of money. It doesn't take a large amount of money to invest. Really what it comes down to is the compound interest and starting early. If you put a little bit of money and you do that early on, by the time you retire, you're going to have a huge sum of money. And so don't get bogged down by, I don't have enough, or I'll wait till I get a better job, or I'll wait till I have more money to invest. Small amounts of money, especially when you start early, can really make a big difference. So do that. It also kind of, this is another truth, that how much you make makes zero difference when it comes to savings and investing from this point. And let me get this down, I'll make the point. You can have somebody who makes a lot of money and doesn't save anything. And you can have somebody who doesn't make hardly anything and saves a lot of it. So your savings rate, maybe that's a better way to put it. It doesn't really matter how much you make, because I think we've talked about this with a McDonald's employee, who makes $30,000 a year and saves 10%. So at the end of it, they end up, in our example, with $3,000. And then we have somebody else who is a NFL star, makes $1 million, saves zero of it, and at the end of the time has zero saving. And so how much you make really doesn't determine whether or not you can save or not. So keep that in mind as well. One of the other things I want you to remember is that you can really do a good job just by keeping it simple. It does not have to be complex. We could probably get by just fine with a total stock market and a total international stock market. There's many more variables out there. If you want to add other complications to it and other things, many people do, and that's fine. But a good investment portfolio is not complex. We talked a little bit about what you guys should be doing, and we talked about the 5 foundations, and I want you just to remember that your car and not having a loan for your car, and your college and not coming out of college with debt if you can help it, takes priority before you end up doing investing. It doesn't make any sense to be investing as soon as you can at 18 and then have a huge car loan that you're paying every month and college bills that you're going to be paying for many years after college. So take care of these, make sure that these are as low and hopefully zero before you start adding money into investing. One of the things that we're going to need to know is the difference between a Roth IRA and a 401k. Just a few things to kind of to keep in mind. If you leave a job, let's say you have a job at one place and then you leave that job, your 401k will not automatically go with you. You'll have to move that to your new job. So another way to put this is tied to your job. A 401k is tied to your job. A Roth is not tied to your job. Now, there's some good things about it being tied to your job, and there's some negative things being tied to your job. You know, one of the things that you need to know is that if you do move jobs, as we said, this one will kind of be with you. If you do move jobs with 401k, you're going to have to move it. A positive about your 401k being part of your job is that sometimes there's a match where your company, if you put in $1, they'll put in $1. And they'll do that up to, you know, a certain percentage. And so sometimes this can be hundreds or even thousands of dollars over the course of a year. That's basically free money that they're just adding. There's no match in a IRA over here. You're just basically on your own. There is an advantage though to the Roth IRA, and that is that there's a wide range of funds available, of things that you can invest in. Over here, the funds are limited to what your boss says or what your company says. And sometimes those are really good funds that are available in your 401k. I told you my wife has some really good funds in her 401k, and they can be really poor choices. And so it really kind of depends. Another thing too is that you can't control the expenses on the funds for your company over here. If you don't like the expenses here, then you just can find a different company or find a different fund. So those are some differences. A huge difference we haven't talked about on this video yet is the taxes. This is going to be, when you put money into this, you have already been taxed. So, at the time of withdrawal, when you want to retire, you've already paid taxes, and so over here, you have not yet paid taxes. So you'll pay these taxes later on, and that's something to remember, and it's something to consider, depending on which one you want to put in. But definitely, you should always contribute to a 401k if you have a match. It's free money. One of the things I want you to remind you of is that it's never a good idea to borrow money out of either one of these funds if you get into problems, if you get into debt, if you have financial issues. And then the main reason is there's penalties for pulling it out early before a certain age, and you know, the taxes that you're going to have to pay. And so, you know, there's some scenarios where if you took out $100,000, you would actually only be able to receive about $60,000 of that, simply because there was so much penalty and taxes involved. We did talk a little bit about the small cap and the mid and the large. You should also know the other terms that go with these. You know, the small cap is our aggressive. This is our growth, and this is our growth in income. And you might see it either way on the test, so I'm just giving you a heads up to know small cap, but also know that small cap can also be called aggressive. Some of the stuff that we've talked about too, about good investments, you know, mutual funds, we hit that over and over, but we haven't talked too much, or you should at least remember that stuff like gold and stuff like viaticals and stuff like futures, you know, guessing the price of something in the future, those are all bad investments. So not only do we need to know for our tests the good investments, but we should also be aware of the poor investments or the bad investments. You should know the risk return ratio, and that's basically as the risk goes up, hopefully your return also goes up. I always say it, why else would you take the risk? If there's not going to be a chance you're going to make more money, then why would you do it? But we also want to remember that we don't want to go too far over this risk ratio, because we can get into some crazy stuff that just doesn't have a good chance of returning stuff. So we don't want to go too far down the risk, and we don't want to be too conservative and not take any risk, because then we're not going to be able to make any money, and with taxes and inflation we're going to end up behind. So we really want to end up someplace where we're taking some risk and getting some return. Now this is going to differ for lots of different people. Some of you are going to be comfortable kind of here, some of you are going to be more comfortable taking less risk, but you really do need to take some risk in order just to beat inflation and taxes. I think that if we kind of talk about different types of investments, know different types of investments, know why some are better than others, that's going to give you a good idea of things that might be on the test. I haven't hit all of them. You should know annuity. I haven't put that up on the board. You should know that. You should know the difference. You should know what liquidity is. We talked about that. You should know what risk is. You should know what the risk-return ratio is. You should know what an investment strategy is, like how you want to plan your investments, how you want to do it. You should know what a portfolio is. And basically, a portfolio simply is all your stuff. So if I have mutual funds and I have gold and I have bonds and I have real estate, this whole thing is my portfolio. That might not be our recommended portfolio, but that's an example of a portfolio, and you should know that. One of the things I probably will ask you to do on the test is tell me a little bit about what you have learned. And maybe you can simplify this by saying, kind of given a scenario, if somebody gave you $10,000 and they told you that the only requirement is that you invest that you invest this money, what would you do? What are some things that would go through your mind? What are some strategies? What are things that you'd want to make sure happen? What are some things that maybe you'd want to make sure you avoid? Those types of things are important, and that's really your investment strategy, and there's some stuff on the test. In fact, I'll tell you right now that may be your very last question on the test. What have you learned? And give me a little bit of information. So I think that's enough. I don't want to keep you too much. This does not cover every single thing that will be on the test, but it covers a lot of it, and I really think that watching this will give you an advantage over those who don't. So relax. If you've been paying attention and listening, then you're probably in good shape, and I wish you luck.